So as stocks and gold are at record levels, we've talked a lot about it over the last few days and weeks because you are hard pressed to decide where to put your money, and if you are showing gains, what to do about it. Do you take the profit and pay the tax? Or do you stay on, or do you hedge? Well, Bitcoin has never been more expensive as well, people are looking for returns outside traditional assets, 123,000. But remember, Bitcoin is still priced in dollars, and the dollar has weakened since April, and that suggests a lack of confidence in US growth. Mohamed El-Arian and Risha Sharma have both been on this program last week and agreed that there are no easy answers to this conundrum.
If you're an individual investor, you have to ask the question, what will hurt me more, missing on returns or losing some capital? Because the last thing you want to do is sell when the market has a drawdown.
If you want to buy into America, you have to be clear that you're buying AI. But outside of AI plays, the rest of the world looks much more attractive.
Now, John Petrides is the portfolio manager at Tocqueville in asset management, joins me now. You've heard the arguments, you know the theories, you've read the same things the rest of us done. Everybody is expecting it's a correction. It's a question not if, of when. We can't time it, but it's coming at some point.
Yeah, I think that's right. I mean, to think that the stock market will go up and to the right in perpetuity is just silly. That's ignoring the entire history of financial assets since the beginning of time. The reality is, though, when stock prices come down, the question is for how long, right? When does it happen? We don't know. For how long, right? And then what's the percentage of the drawdown? So as we've seen, really for I don't know the past 20 years, when the stock market has drawn down, it doesn't stay down for very long.
The difference, of course, this time is the analogy with the dot-com boom and bust, where there was a very specific reason that it rose so sharply, and AI is that reason now. Of course, AI is not going away, and NVIDIA and all the players will be making money in the future, just not as much. So if you are long in all this tech, what do you do?
Right. So it's a good question. If you're in a tax-sheltered account, is it appropriate and prudent to check your allocation and take some off the table? Absolutely. If you're in a taxable account and you're sitting on massive unrealized capital gains, consider things about donating money to charity, considering about gifting some of the positions away, considering about maybe putting an option strategy around it to protect the volatility. And then, of course, it is make sure you understand what it is that you own and why you own it. I don't think the stock market in general is in a bubble. I do think the U.S. stock market, judged by the S&P 500, is expensive because it's in a position that it's never been in before. The S&P 500 is the most concentrated it has ever been in. If you take the tech sector and then you add
Right.
Google, Meta, Amazon, and Tesla, it's like 50% of the index. So you just need those companies to sneeze, and the stock market, judged by the S&P 500, will come down. But if you look at the stock market on an equal weighted basis and say a company like NVIDIA has the same market cap as a company like Dollar General, two completely different businesses, and you look for them pound for price, it's not expensive. If you're looking at sectors like small cap or international or emerging markets, those sectors, in my opinion, are not expensive. So there are other places to put your capital than blindly buying a passive index like the S&P 500.
The difficulty, of course, is greed, and a combination of greed and FOMO. That is a lethal combination for any investor, because look, I hold my hands up. I lost a lot almost during the dot-com boom and bust because it was all, well, you know, not all, but you know what I mean, because it was always going to be, I'll change the strategy next week. I'm going to ride this just a little bit more. Oh, no.
Yeah.
Now, and then, of course, as soon as the market turns, I'm following it down because I daren't sell into the losses. I'm told never to sell into. So that's the problem.
Yeah. I mean, there's so many components to that, and that's where staying disciplined to your financial objectives are the key, right? And what are you trying to achieve with your portfolio and your nest egg? But I do believe that to your point of greed, we need a sell-off to flush the greed out.
Right.
Because when stocks and financial assets continue to rise, people get complacent, right? They forget, if it's sunny for 30 days in a row, people forget that it could rain some days, and they sell their umbrella. So you have to realize that you need a sell-off to wake people up, because when things keep going up and to the right, they get complacent and bad people start making bad decisions with risk.
I just want to get you one quick answer from you on gold. I am not, I mean, gold has always befuddled me. They say gold should be part of everybody's portfolio in some shape or form. Do you subscribe to that? And if so, what's your preferred method of access?
Fantastic question. We own gold. For our clients at Tocqueville, we own gold. We increased our gold position in 2023. It turned out to be a fantastic call. We're still buying gold, but we're now buying it at a significantly lower weight than we once were. And the reason for owning gold is this. I think I'm a smart person, but I'm smart enough to know I don't know everything. So when that black swan event happens, right, I know I have gold. Or as like Peter Lynch once said, the famous investor, sometimes it's nice to be caught with your pants up. And that's what it means to have gold as a portion of the portfolio. At 4,000, gold is true. There's a lot of math behind why gold is a good thing, but there is the greater fool theory behind gold. I'm going to sell you my gold because you're more scared than I am, right? There's a component to that. And we're at 4,000 per ounce. And there are reasons to be scared. The U.S. debt situation is not great. The world is experimenting with going away from the dollar. You do have valuations elsewhere that are higher. You have momentum in the market, right? There's a lot of momentum drivers going in the market. Right. People fear that if the Federal Reserve, if President Trump or when President Trump hires a new Fed chair and they print more money, that's going to devalue fiat currency, paper currency. So why not own more gold?
I'm grateful, sir. We will talk much more in the days and weeks ahead as you help us navigate it. Thank you, sir.